Now, amidst the market rally unease, the emotion our first guest is feeling, bullishness. Diane Avigdor, Vice President and Portfolio Manager and Head of Trading at Barometer Capital. Good to have you with us again.
Thank you very much.
Bullish. Blood on the streets. That's when you buy, they say.
Well, that's true. But I think the market, it's safe to say that the market is going to do some price discovery over the next few weeks.
What do you mean by
So
that?
be careful. Well, today it's price discovery. Overnight was price discovery. Yesterday, down 2% was price discovery. Look, the S&P hasn't had a 5% correction in over 6 months. It's up 8% month to date. Even the bulls, this is why it felt so bad yesterday afternoon, even the bulls think that it's okay to have a correction. The bears have reached since last Friday. If you remember that huge reach for a rally into the close on the option expiry, it was like everybody was throwing in the towel.
Okay, so if we're looking for price discovery here, we're basically looking to see, we're testing support to find out how much further stocks fall. In your estimation, how much more downside do we see before we see the leg up again?
I'd love to see at least 5%. In the back and forth, the rally and sell-off and the range-bound trading that I think is going to ensue in the next 2-3 weeks, I'd be looking to protect my more volatile positions. Maybe you sell some calls. Maybe you buy some puts. Puts are cheap. Put option volatility price is cheaper than the call, so you could protect your positions a little, buy some futures. If you can't do it, go to somebody who can manage your portfolio tactically. I think that you do some protection, some short-term trading. And then in the next 2-3 weeks, we have some directional view. We can talk about that a little further.
Option strategies, very effective form in many cases of insurance against market downside. Yeah. Limits your upside, of course, to a degree. But you point out as well, and you brought a graph with you that shows that the hedge fund community has underperformed. And usually these are the guys who like to boast that they can factor out this kind of volatility.
That's very true. And yet, look, there's something like between 5 to 7% underperformance. And where I'm going with that chart is actually that the sell-offs are probably going to be supported by the money inflows in the buying that you see today as well in global markets, particularly in the U.S. As these guys, nothing has really changed in the last 2 days, frankly. Yesterday's testimony by Bernanke was not anything new. And as a matter of fact, the market rallied to brand new highs right before it sold off. The conversation about quantitative easing tapering off, maybe in the summer, maybe a little later, is not the first time we heard that. Yesterday, we heard that from other Fed speakers for the past 2 weeks. And as a matter of fact, those news just came out at 2 p.m. By then, the market was selling off already. So there is a little profit taking going on here just for the sake that we've been up so much.
Despite giving a little poke to the hedgies there, you are invested with hedges in place.
We are invested, and we can put hedges. We're a tactical manager. We can go to cash. We have no mandate to keep a particular minimum level of cash, so we can quite raise our cash. And yes, we do utilize the options market and the futures market to hedge our positions.
Give us a greater sense as to how you would go about doing that in this environment.
In this environment, it's very easy to just sell futures. Of course, it depends on what your exposures are in a portfolio, what your correlations are. Generally, I think that it's safe to use index futures to protect at least a portion. The one thing I don't want to do, I don't want to make money on the hedges. I'd rather the market went up, but I would like to take the volatility out of the positions.
What about putting some cash onto the sidelines, waiting for that 5% correction, and then deploying that cash once you've seen that happen?
Absolutely. And go to where the strength has been. Don't buy the weakness. Don't buy the lows. Buy those sectors and those stocks that have held up the best, that are making new highs, that are relatively strong, because when the market turns back up, those are the ones that tend to outperform.
What sectors do you like the most?
Well, look at it today. Look at Wells Fargo. Look at ING. Look at Merck, the pharma. Last time we spoke, I said, diversify outside of Canada. The Chinese numbers are not indicating a commodity super cycle or cycle anytime soon, but it's a commodity. It's a consumer-led 7.5%. So maybe other sectors will benefit better. Healthcare, consumer discretionary, financials.
So these are the defensives you're talking about here. Stocks with the highest buyback ratio. You want to see companies taking the cash that they've been sitting on and start deploying it by way of buying back their own stock.
That's true. Or dividend yield, or dividends, or increase in dividends. This chart just showing how people are looking to be more secure and to get stability out of their investments. And we've spoken about how the defensives have led this rally so far. It's been the large cap, the healthcare, utilities have lagged the last couple of weeks, but year to date they're still doing very, very well. And the financials, the U.S. financials, they're going through a repricing of sorts. They're a little defensive. They can be characterized as defensive in terms of what they pay back and buybacks. But should the trade become a cyclical trade? They'll benefit from that. There's a housing recovery going on and a consumer recovery in the States. So I think that using some good financials in the States would be prudent.
And again, back to that waiting for a 5% correction in the S&P 500. You mentioned Wells Fargo, by example. It was trading below book value for the longest time. Now it's trading 1.4.
Right.
Still, I suppose,
Still
cheap
below,
on a relative basis.
Still cheap on a relative basis. That's
particularly
right.
compared to Canada.
Right, and that's right.
But if you had a 5% correction in Wells Fargo, you would probably see it bring it back down to 1 to 1.
You would bring it back, and it would be a buying opportunity, provided all else is equal.
Diana, great having you with us again.
Thank you very much for having me.
Diana Avigdor, Vice President and Portfolio Manager and Head of Trading at Barometer Capital Markets.